Imagine the entire world as one colossal skyscraper, not a normal building, but a structure so vast it stretches beyond the clouds. Every floor represents a nation, every beam, every column, every bolt. A financial connection. For the past 30 years, this skyscraper has stood tall, not because it was perfectly designed, but because its foundation held. And that foundation was Japan. Quiet, unassuming, almost invisible to the people living far above. But now, without warning, that foundation is starting to crack. The people living on the upper floors, the United States, Europe, the emerging economies, don't fully understand what's happening yet. They don't see the damage below, but they can hear it. A deep, unsettling sound. A slow, echoing crack, traveling up the walls. What they're hearing is a financial earthquake. An earthquake worth $7 trillion. And the epicenter isn't Wall Street. It's not the city of London. It's not Silicon Valley. It's coming from deep beneath the structure, from Japan itself. Japan, the country long known as the planet of technology, the land of bullet trains, robotics, anime, and sushi. For decades, Japan wasn't just another floor in the building. It was the support column everyone leaned on. A leaning wall. Stable, predictable, endlessly reliable. Japan offered the world something incredibly rare. Cheap money, and the world built entire financial empires on top of it. But now, that wall is beginning to crumble. And if it gives way, the entire temple may follow. This isn't about a single bank failing. It's not about one corporation collapsing. This is about a bond market. Japan's bond market, worth over $7 trillion. A market large enough, powerful enough, to reshape the global financial system itself. To understand how we reached this moment, we need to rewind way back. Late 1980s, early 1990s. Japan was unstoppable. Its economy was booming. Its companies were buying landmarks around the world. Its real estate prices were climbing into the stratosphere. At the peak of the bubble, land prices in Tokyo had risen more than 5,000%. To put that into perspective, the land beneath the Imperial Palace was once valued higher than the entire state of California. Banks were lending billions against land that existed only on paper. Prices were no longer tied to reality. They were tied to belief. And belief is fragile. When the bubble finally burst, it wasn't loud. It was slow, relentless, and devastating. Companies collapsed. Banks were left holding mountains of bad loans. Balance sheets turned toxic overnight. Consumers stopped spending. Businesses stopped investing. Confidence evaporated. What followed was a vicious chain reaction. Falling demand, falling prices, job losses, and then something far worse than recession. Deflation, an economic deep freeze, where money becomes more valuable by not being spent. And Japan was trapped inside it. To fight this, Japan's central bank, the Bank of Japan, made a radical decision. In 1999, it cut interest rates to zero. Zero, meaning if you put money in the bank, you earned nothing. The logic was simple. If saving feels painful, people will just spend. If people spend, companies grow. If companies grow, the economy heals. But healing never came. Instead, Japan entered a new era. An era no major economy had ever experienced before. An era of permanent cheap money. For the next 25 years, Japan kept interest rates near zero, sometimes even below zero, regardless of what was happening in the rest of the world, while the US raised rates. While Europe tightened policy, Japan stayed frozen in time, and that decision quietly rewired global finance. Out of this environment emerged something powerful and dangerous. The yen carry trade. Here's how it worked. Investors could borrow Japanese yen at almost no cost, sometimes literally for free. Then they would take that money and invest it elsewhere in US bonds, European debt, emerging markets, stocks. Imagine borrowing at 0% in Japan and earning 4 or 5% abroad. No factory, no invention, no risk, at least, not on the surface. Just easy profit. Over the years, trillions of dollars flowed through this system. Japan became the silent engine of global liquidity, funding growth everywhere while receiving almost nothing in return. The skyscraper kept rising, higher floors, heavier loads, all resting on one foundation. And then, by 2026, the engine began to shake. A new Prime Minister, Sanai Takaichi, announced massive government spending plans over $135 billion. But there was a problem. No clear explanation for how it would be funded. And investors were already nervous, because Japan wasn't just borrowing more, it already had the highest debt-to-GDP ratio in the developed world. Over 260%. In other words, for every dollar Japan produced, it owed more than 2.5. Confidence cracked when the government attempted to sell new long-term bonds, something that usually happens quietly. Almost no one showed up. Demand collapsed. And when demand disappears, prices fall. Yields, the interest investors demand, exploded upward. For the first time in decades, Japan's bond markets stopped behaving. The foundation began to slip. That's when the shockwaves hit the rest of the building. Japanese investors are among the largest foreign holders of U.S. debt, over $1.1 trillion. As yields surged at home, those investors began pulling money back to Japan. Economists call it capital repatriation, but in plain terms, they sold foreign assets to survive at home. U.S. bond yields rose. European yields followed. Stock markets stumbled. The U.S. dollar weakened. And fear rushed in. Money fled to safety. Gold surged. Silver followed. Gold smashed through $5,000 an ounce, not because the world was suddenly richer, but because confidence was evaporating. This is how cracks travel upward. A decision in Tokyo raises mortgage rates in New York, car loans in Paris, business financing in Berlin, and yes, even credit conditions in Egypt, Saudi Arabia, Morocco, and Iraq. When borrowing costs go up, it hits hard. Every floor feels it. This is not just Japan's problem. This is the potential end of an era defined by easy money, cheap debt, endless liquidity. For 30 years, the global economy was built on the assumption that money would always be available and always be cheap. That assumption may be ending, and like any withdrawal, the pain could be severe. So now we face the real question. Are we heading toward a financial nightmare in 2026? Will the United States, the European Union, and the IMF step in, not to save a bank, but to stabilize an entire nation's bond market? Or will the world discover too late that the foundation it depended on was far more fragile than anyone realized? The cracks are already there. The sounds are getting louder. The only question left is, will the building hold? What do you think? Let me know in the comments below. If you found this breakdown valuable, give it a like, share it with someone who needs to see it, and don't forget to subscribe. I'll see you in the next one.